Welcome to our deep dive on whether you should pay off debt or invest first. In this video, we will walk through a clear, prioritized game plan designed for young professionals choosing between aggressive debt elimination and maximizing compound growth. To keep things structured, we will begin with the big picture decision, transition into rules of thumb, move through a visual decision flow, and then build a concrete step-by-step plan, a case study, and quick quizzes to cement your understanding. Here is our agenda. First, why this choice matters. Next, rules of thumb you can trust. Then, a decision flowchart and mind map. After that, a step-by-step action plan. Then, a case study with numbers. We will include short quizzes to test your understanding and finish with key takeaways and a concise recap. This choice matters because high-interest debt can erode your financial progress, while investing harnesses compounding to build wealth. The correct order of operations converts what used to be debt payments into consistent investment contributions, accelerating your path to financial freedom. With that context, let us define simple rules you can follow. Here are the guiding rules. First, treat interest rates above 7% as an emergency. 11% or more should be paid off immediately, because eliminating that debt is effectively a guaranteed return equal to the interest rate. Second, debt between 3 and 5% is considered cheap, so you should make minimum payments only while directing the rest of your capital toward investing. Third, always capture the full employer match in your 401k first, because it is effectively free money. Fourth, after capturing the match and eliminating expensive debt, increase retirement contributions to 15 to 20% of your income. Fifth, fund a Roth IRA next if you are eligible, and then consider taxable investing. Finally, only after these steps should you accelerate low-interest debt or add extra to a taxable brokerage account. This flowchart illustrates the decision path. We start by checking for any debt at 11% or higher. If yes, pay it off immediately. If not, we check for debt between 7 and 10% and prioritize paying that down aggressively. If neither applies, we look for an employer 401k match. If there is a match, we contribute at least enough to capture it. If there is no match, we can proceed after maintaining a small buffer. After the match is captured and expensive debt is eliminated, we increase retirement contributions to 15 to 20%, then fund a Roth IRA if eligible, and finally decide between accelerating low-interest debt or contributing to a taxable investment account. This ensures guaranteed and tax-efficient wins are secured before chasing market returns. This mind map splits your decisions into two branches. On the debt side, anything above 7% is prioritized, with 11% or more treated as urgent. For 7 to 10%, pay it down quickly. For 3 to 5%, make minimum payments only. On the investing side, first capture the employer match, then raise contributions toward 15 to 20%, fund a Roth IRA if eligible, and finally allocate additional funds to taxable investments after these priorities are met. Follow these steps in order. First, inventory your debts by annual percentage rate and sort them from highest to lowest. Second, immediately contribute enough to your 401k to get the full employer match. Third, attack any debt at 11% or higher until it is gone, even if it means temporarily reducing excess savings to speed up the payoff. Fourth, aggressively pay down remaining debt in the 7 to 10% range. Fifth, maintain minimum payments on 3 to 5% debt and avoid accelerating it for now. Sixth, once the expensive debt is cleared, raise total retirement savings to 15 to 20% of your income. Seventh, fund your Roth IRA if you are eligible. Finally, decide whether to accelerate low-interest debt or invest extra in a taxable brokerage account based on your risk tolerance and goals. This table ranks the actions. First, capture the employer 401k match because it is an immediate, risk-free return. Next, pay off debt with an APR of 11% or higher, followed by 7 to 10% APR debt due to their strong risk-free returns when eliminated. After expensive debt is gone, raise retirement contributions to 15 to 20% to harness compounding and tax benefits. Then, fund a Roth IRA if eligible. Finally, allocate remaining dollars between taxable investments and optionally accelerating 3 to 5% debt, depending on your goals and risk preferences. On the left, paying down high APR debt yields a guaranteed return equal to the interest rate, reduces monthly obligations, and removes volatility risk. On the right, investing early captures compound growth, secures the employer match, leverages tax advantages, and provides flexibility once expensive debt is cleared. The optimal strategy blends both: secure the match, crush high-interest debt, then scale investing. In this case study, the individual earns $70,000 with an employer match of 100% of the first 4%. They have a $5,000 credit card at 22% and a $20,000 student loan at 4.5%. First, they contribute 4% to the 401k to capture the full match. Second, they attack the 22% credit card while paying the student loan minimum. By March, the card is at zero. Third, they redirect the former card payment into retirement to reach a total savings rate of 15% and automate it. Fourth, they fund a Roth IRA if eligible and send any remaining surplus to a taxable account. For quick math, eliminating a $5,000 balance at 22% avoids approximately $1,100 of annual interest if the balance would otherwise persist. Redirecting a $300 per month payment into investing equals $3,600 per year, which could grow to around $49,000 over 10 years at a 7% average return. The student loan remains on minimums because its rate is relatively low at 4.5%, and investing is expected to produce a higher after-tax return over time with tax advantages. Quiz time. Which action provides a guaranteed return equal to the interest rate you avoid? Option A, paying off 11% or higher debt. Option B, investing in a taxable brokerage. Option C, buying individual stocks. Option D, holding cash in a checking account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, paying off 11% or higher debt. Eliminating that interest is equivalent to earning a risk-free return at the same rate, which is difficult to reliably achieve in the market after tax and fees. Next question. After capturing the full employer 401k match and eliminating high-interest debt, what comes next? Option A, accelerate 3 to 5% debt. Option B, increase retirement savings to 15 to 20% of income. Option C, stop investing until all debt is gone. Option D, move everything to a savings account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, increase retirement savings to 15 to 20% of your income. This captures compounding and tax benefits before considering accelerated payments on low-interest debt or adding more to taxable investments. These are the key points. Interest rates above 7% are urgent, with 11% or more being top priority. Always capture the full 401k match. Keep 3 to 5% debt on minimum payments while you invest. Target a total retirement savings rate of 15 to 20% after handling the match and expensive debt. Use a Roth IRA next, then taxable investing. Finally, convert former debt payments into automatic investments. This content is educational and does not constitute financial, tax, or legal advice. Your circumstances may differ, and tax rules can change. Please consult a qualified fiduciary financial advisor or tax professional before implementing any strategy discussed here. Here is the summary. First, capture the full 401k match immediately. Second, eliminate debt at 11% or higher, then 7 to 10% next. Third, raise total retirement savings to 15 to 20%. Fourth, fund a Roth IRA if eligible, and then use a taxable account. Throughout, keep 3 to 5% debt on minimum payments until the higher priorities are complete. Thank you for watching. If you found this useful, please like the video, share it with a friend, and subscribe for more content. In the comments, tell us your plan. Are you paying down debt first or prioritizing investments? Your insights may help others too.